If you've ever been alive in a modern society, you're probably going to need one of these three things: a house, a car, or an education. Some people choose to forego all three, but chances are you're going to be needing all three. Not everybody has the money to just pay for these things and then have them. That would be incredible. So that is where loans come in. Loans. So what is a loan? A loan is basically borrowed money. It's a sum of borrowed money from an institution, bank, or heck, even another person. Loans give you the ability to have that car or have that house now. Naturally, since this money is borrowed, you're going to have to pay it back. Each month, you'll be required to make payments on your loan until the balance of that loan hits zero. But life isn't that easy. Institutions can't just lend money out to people for free because then they'll go out of business. So that's why they charge what you call interest. Along with the regular payments will be the interest fee that they charge. Logically speaking, that means lower interest rates and fewer payments will be better for you. Student loans are a little bit more special because they come in a couple different categories, two of which I will be talking about in this video: subsidized loans and unsubsidized loans. In general, with these two kinds of student loans, you do not have to worry about making payments on them until you are either finished with school for 6 months or at least in school half-time. After you've graduated, you have a 6-month grace period before you have to start making payments. This is basically the time for you to find a real job and kind of get your situation handled before you start making regular payments on something. Subsidized loans are where the United States Department of Education pay for your interest during the time you're in school and during the 6 months after graduation. It'll be like you had just gotten the loan at the time when you start making payments on it. Your school determines the amount based on your financial need as well as the cost of education at that particular school. That's why different schools will let you borrow different amounts. On the other hand, an unsubsidized loan is a loan where the United States Department of Education does not handle the interest. From the time you borrow it all the way until the time you have to start making payments for it, the interest will not only accumulate, but it will add to your principal amount. And so when the time comes to start making your payments, you will be charged interest not only on the original amount you borrowed, but the extra accumulated amount that added on to the loan. I recommend paying the interest off every single month. You will set a payment date every single month, and if you happen to miss that payment, you will become delinquent on your loan. Here are some reasons not to be late on your payments. Number 1, it hurts your credit score. Your credit score is what they look at to determine how high of an interest rate they will charge you. If you have a worse credit score, that means a higher interest rate, meaning you will pay them more money. Number 2, usually if you miss a payment, you will be charged a late fee. It means you pay more money. And reason number 3, interest typically accumulates daily. So if you happen to be late on a payment, that means that interest will keep accumulating on that thing until you pay it off. So if you're late on your payments, you'll end up paying more money. Now, if you don't turn in your payments for a consecutive number of cycles, 2 months, 3 months, it depends on the institution, your loan will go into default. Most federal student loans will default in 270 days. So what happens when you default your loan? Well, you basically lose whatever the loan was on. If your loan is for a car, you'll probably have your car repossessed. Your entire loan balance will be due in full immediately. Collection fees, which are typically charged on all loans that default, will usually be added to your balance. They might take up to 15% of your paychecks. Your Social Security, disability income, and state and federal tax refunds can be seized. And on top of all of that, all of the unpaid interest and the fees that they tacked on will be added to your main balance on the loan, which means that future interest will be calculated on that too, which means you pay more money. You see a recurring pattern here? If you don't pay, you end up having to pay more. So make your payments. It's good for you, trust me. Something important I've learned from our CEO, Mr. Greg Hill, is that it all starts with the finances. Sure, everybody faces problems in their daily lives, but the only way you'll be able to face those problems is if you're in an okay financial situation. In order to have the money to survive, it is crucial that you don't pay too much or lose all of it. That is where the importance of a good credit score comes in. Make your payments on time and don't do anything that will lower your credit score, because it hurts. So, to summarize everything you've learned today, a loan is borrowed money. Institutions charge interest, which is included in your monthly payments that you have to make. Student loans come in many categories, 2 of which are subsidized and unsubsidized. Subsidized loans are loans where the USDE pays the interest until you're out of school for 6 months, whereas unsubsidized loans do not have that advantage. If you are ever late on a payment, you go delinquent on your loan, which will hurt your credit score. You will remain delinquent on that loan until you've paid all of your late fees and any extra fees you've been charged, along with the payment that you missed. If you consistently don't make payments or are delinquent for a certain amount of time, your loan defaults. If you default on any kind of loan, especially your student loans, you are in for a world of hurt. Some people might look at this entire situation as very difficult, like, oh, loans are bad, it's bad to borrow money. But actually, on the contrary, it can be very good to borrow money. How many of us are going to ever have just $200,000 to drop on a house? Furthermore, if you've got loans and you've consistently made payments, it will increase your credit score. People without loans don't have as high of a credit score as people with loans that are responsible about making payments. If you've got a great credit score, your financial institution is more likely to offer you great deals and really awesome discounts because they know, based on your score, that you are responsible with your money. I hope today's general rundown of loans was helpful and informative. I didn't cover a lot of the minute details in this video because that would take up too much time, so if you've got questions, please email me. My email address is listed down below in the info section. Good luck with your finances, good luck with school, and good luck with life. Spend wisely and save wisely. See you later, folks.